Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Mathew. Today, I'd like to start with a conversation with the Chief Investment Officer of a mutual fund that has had a couple of offerings in the equity space and that is introducing another one. I'm talking about Trust Mutual Fund, and so far they have a flexicap fund, which, as you know, is a clean slate sort of an equity fund that allows the fund manager to pick and choose from a wide variety of options, including market capitalizations, but not least of which market capitalizations, and a small cap fund. And this is a mutual fund house that is now going to be launching another mutual fund scheme. We'll talk about that, and we'll also talk about the experience so far and what the outlook is going forward. Joining me now is Mihir Vora, the Chief Investment Officer of Trust Mutual Fund. Mihir, thanks so much for taking the time. Let me ask you this at the start. You started your flexicap fund in April of last year, the small cap fund at the end of last year. What is the kind of learnings that you've had, and what is the experience that you've had in building your portfolio? What has worked and what hasn't?
Sure. Hi, Alex. Thanks for having me on the show, first of all. It's been a very eventful 14 months, I would say, since we started our first fund, which is the flexicap fund, as you mentioned. And, immediately after we launched the flexicap fund, we've seen, the election results and the volatility around that. Then we've seen, the Israel conflict, and then we've seen the budgets and lots of events, keeping us busy. Always interesting times, as you would say in the markets. But I think what has also been validated is the fact that there are always opportunities for stock picking in the markets across market caps. And the reason why we launched the flexicap fund first is obviously, first of all, it's the biggest category, and it is the flagship fund for most mutual funds. But then we launched the small cap fund because we really wanted to exploit all the stock picking opportunities which is there in the small cap space, which is a much larger number of stocks compared to the larger mid space. So I think it's been exciting 14 months. Lots of learnings. Most importantly, how to deal with volatility and how to kind of keep picking stocks across different market conditions.
Okay, I use these conversations to reinforce for my viewers and both your investors as well as your prospective investors what the philosophy is when you're constructing your portfolio. So can you give me examples based on what you currently have in your portfolio, or what you might have exited over the course of the last few months that reinforces that philosophy?
Sure. So essentially, we believe that earnings growth drives stock prices in the long term, right? So we are growth investors, and we look at earnings growth potential when we look at stocks. The crucial difference between our approach to earnings growth or growth investing and probably other styles of growth investing is that we believe that it's not only the next few years of projections of earnings growth that matter in valuing a stock, because valuations are a complex thing. But in high growth stocks and sectors where the runway of growth is expected to be long, there the valuations today will not necessarily be influenced or determined by what growth you expect in the next 1, 2, or 3 or 4 years, but it will be largely a function of what you believe the length of the growth runway is going to be, because the stocks which grow at good rates, and it doesn't have to be 40-50% compounded for the next 20 years or something like that, but even if it's 15, 16, 17, 18% growth or 20% growth, but expected to grow for 10, 15, 20 years, then the future profits, the longer term profits, not the next 4, 5 years profits, will be the predominant determinant of the current market value. So this is what we call the terminal value, which is the value of the longer term profits. And this is what determines the current market cap to a large extent, because mostly investors and analysts are able to, with some comfort, predict the next 2 or 3 years. And if you read any research report, typically the projections are there for the next 2 or 3 years. But unfortunately, that's not how the market thinks. The market is already discounting the longer term growth prospects in such high growth and sectors. And so what happens is that if you continue to look at only the near-term growth and apply the normal ratio like PE or something like that, then these stocks will look expensive and you will probably not be able to participate in that. But once you start to look at the longer term potential and the length of the runway of growth, then it begins to make more sense. And in the last few months, we have seen that stocks which are of high growth nature have been very volatile, but they've also rebounded very sharply and smartly and probably even touched their previous highs and crossed the previous highs because the secular story was in place. So I think holding on to our core beliefs is something that we've done. Of course, there are always pockets of overvaluation, pockets of undervaluations, which we will use to buy or sell on a tactical basis. But I think the core philosophy remains the same. It remains reinforced.
Okay. I asked another CIO this week, equity CIO, whether they were caught perhaps a little unawares by the ferocity of the rebound in the broader markets, in particular since April of this year. And they were candid enough to say yes, that they were. I'm just wondering what your own experience in your flexicap fund was, because when I look at the portfolio, 60 stocks from what I see, and I've not seen the latest fact sheet, but there is a tendency or a tilt, if you can call it that, more towards the large cap space. And so to that end, maybe you've not had the benefit of the kind of run you've seen in the broader markets. Is that fair?
Oh no, our flexicap fund typically has had a significant exposure to mid and small caps. In fact, if you look at the May-June portfolio, it's almost 30% mid cap and 17-18% in small caps. So to the extent we have 45 to 50% in mid and small cap. And if you look at the last 14 months history also, we have had mostly around 50% exposure to mid and small cap. So we've always run the flexi cap in a market cap agnostic fashion, tried to pick the best available stocks across market cap. We've never made a top-down call on large versus mid versus small. We just pick the best 60 bottom-up, risk-return stocks that we can. So to that extent, we've not really lost out on the mid and small cap rally. Second thing is we also don't take big cash calls. Typically, even if we are uncertain about the market, etc., we will not take more than 5 to 10% of cash. So that's also kind of buffered us or shielded us from the uprise in the market.
But were you surprised at the kind of run that you've seen since April? I mean, of course, this is moving more or less in tandem with several global equity markets, but Indian equity markets have bounced quite substantially. Broader markets over 20% from April lows.
Certainly, but I don't think I was surprised because there were tailwinds, right? Biggest tailwind, of course, is the fact that for the first time in many years, I would say the government and the RBI are on the same page. Both are very clearly saying that we want growth. Second is if you see the DXY, the dollar index, it has started weakening since February, March, and that has by no coincidence also led to FII flows being positive. So the outflows that we saw from September to February turned into inflows after February. So February, March, April, May, June, or March, April, May, June, 4 months, we have seen FIs turn buyers. So I think liquidity, RBI stance, government stance, government spending on infra coming back, all those have led to the tailwinds in the market. So yes, the move has been pleasant, probably a bit sharper than one would have expected, but not completely surprising, I would say.
Okay. Now you are launching, as we speak, a multi-cap fund. I'm just wondering about the positioning and how it's going to be different from the flexi-cap fund, because you just now pointed out that you have a reasonable exposure to the broader markets in your flexi-cap fund as well. So how are you positioning and differentiating that strategy?
Certainly. So the big difference between the flexi and multi-cap category is the fact that this forces the fund manager to look across market caps. We've seen instances in which fund managers turn a bit too conservative, as you mentioned, and keep on getting tilted towards large caps. And if you see the last 5 to 10 years, mid caps and small caps have actually outperformed the large caps in many years. So to that extent, this ensures a minimum amount of diversification across market caps. So it's kind of a forced discipline, as you say. It removes the human bias to become too conservative in volatile times. So I think that's the big advantage of this category. Typically, what happens in the multi-cap category you're forced to put minimum 25% in mid cap, minimum 25% in small cap, and minimum 25% in the large cap category. Now, let's say, for example, markets turn bearish and there's a market sharp correction in the market. And you typically see that when there's a sharp correction, the mid and small cap categories tend to underperform significantly. Now, what happens is, suppose you had 25% small cap exposure and the small cap category underperforms, it means that the weightage will go below 25, right? Uh, what happens is that in volatile times, fund managers probably may not take corrective action and add to small caps. So the bounce back which happens, which also happens very sharp, will not enable the fund manager to participate on the upside in small caps. In the multi-cap, since you have to top it up to 25, if the category underperforms, the mid caps and small caps underperform, you'll be forced to buy when the stock prices go down. So to that extent, there's a natural rebalancing that happens in the portfolio, and you'll be doing the more logical thing, fundamentally speaking, that if the shares that you liked are available cheaply and have underperformed sharply in the mid and small cap, then you should be adding to that. So this forces the fund manager, removes the emotional bias from the fund manager's thinking. So that's a good advantage of the multi-cap category. In our case, as you rightly mentioned and as we discussed, we've always been market cap agnostic in the flexicap fund. So there may be an overlap between the flexicap fund and the multi-cap fund, but then, as I said, you need to have minimum in each category. So that way, I think it'll be a more balanced distribution compared to the flexicap distribution. If I were to give you some statistics on the category per se, the mutual fund industry, what has been doing, on an average, the industry has had 58 to 60% exposure to large cap in the flexi cap category. If I look at all the flexi cap funds in the market, in the multi cap category, the exposure to large cap on an average is about 40%. So if you look at the category, there is a significant difference. Though, as I said, for us, the difference may be a bit lesser.
Got it. Okay. So I got a perspective. There is likely to be, as you pointed out, some overlap because of the way that you run the flexicap fund as well. I'm just trying to understand now where we stand, and we're probably at a crossroads in terms of how trade gets done globally, and we're looking at the possibility of an imminent trade deal between the US and India, and that may be the next trigger. But I'm just wondering how you're reading the tea leaves on the earnings front, because that, as you've pointed out, is what drives valuations and what drives your own decision making. How do you see FY26? And what is your own message to investors with regard to return expectations?
Sure. So returns will be a function of earnings growth and the valuations that you start with, right? So if I were to look at the three components of the market, which is the large, the mid, and the small component, large cap earnings growth for the next year probably will be in the high single digits for the large cap indices, the Nifty 50 or Nifty 100. The mid-cap earnings growth will be around 15-16% in my view. And the small cap index earnings growth probably again will be around 14-15%. So there will be a significant higher earnings growth for the mid and small cap segments. It also might be, interesting to note that in the recently concluded earnings season, the number of positive surprises was a little higher than the number of negative surprises. So it's been a decent earnings season for the March quarter that we just got results for. So I think we are on the right track as far as earnings growth is concerned, and if things pan out well, you might even see earnings upgrades in the mid and small cap segments. So that's on the growth part. Valuation side, I would say we are at average valuations to a little above average valuations, which means that the returns expectations for the next 1 year should be in line with earnings growth. So that's the kind of base case that we are working with. So maybe high single digit returns for the large cap indices, and maybe good 13 to 15% returns from the mid and small cap indices.
Got it. Okay, Mihir, on that note, thanks so much for joining me today, and wish you all the best with the product that you're launching, and we'll speak soon enough once the product is out and once the portfolio is ready.